Doesn't matter how much money you have in your pocket, you can start with as little as $100, $10, even $1. There are stocks like that as well. And today I'm gonna cover two high dividend stocks where the share price is actually lower than $10. It is so affordable that you can invest $500 into this company and start reinvesting all your dividends as soon as with the next dividend payment. And this is great. This is how you grow and compound your dividends and your investments. And then eventually, with consistent contributions, proper diversification, and the market growing and making everything for you, you'll get there where you can forget about all the financial problems that you had before and make your future life financially independent so you can control what you're doing, you can start travel and do all the rest of the fun stuff. House in Florida? Yeah. Do I need it? No. I'll probably invest more. That's how financially nerds think. Hello everyone, Alex is here. I hope you're doing well and I hope you're ready for the summer. It's basically here. And ready to invest into two very good stocks, very promising, also super cheap stocks. They are traded today at less than $10 per share, which is impressive. And they can give you up to 6.5% dividend yields. So let's get started. The Canadian's primary stock exchange is actually experienced a pretty good growth this year. It's been up by 14.89% since the beginning of the year. And TSX, the Toronto Stock Exchange, pretty much recovered from all the pandemic lows, and none of the 11 sectors are actually in the negative territory, which is great. For example, even energy, with all the oil prices coming back to normal, is up 53% since the beginning of the year, which is great. The market is moving into the right direction. We are growing as usually, slowly but gradually, and we're gonna get there. And the first one for today is gonna be Extendicare. The ticker symbol is EXE.TO. This ticker symbol reminds me of Windows 95. Word. That tells you how old I am. Extendicare provides care and services to almost 80,000 citizens in Canada. And they're already showing pretty good performance, pretty good comebacks from the last year's crisis, as they are up 27% since the beginning of the year. This shows that stocks like this also can outperform the major tech stocks that are being on the market, and they've been growing and innovating since the beginning of times. And with the growing aging population in Canada, more and more people are getting older, which is probably okay. And this is actually the way things are supposed to be, right? In the nearest future, actually, the 60 would be the same as 30 today. And people will start living to like 200, 300 years. Right, getting off topic here. What I'm saying here, Extendicare is actually lined up very nicely for the future, where with all the aging population growing, this is the company where everyone's going to be using. Their financials are on point right now. The first quarter performance showed that the company is growing pretty good. As I said, they're up 25% since the beginning of the year. And also one of the most important metric for us, because this is a dividend company, is the funds from operations. And they rose from $7.9 million to $19.5 million. This is what supports dividend payments. This is what we need when we're looking for sustainable dividend companies. Furthermore, Extendicare is focusing on replacing their facilities and the equipment they're using, and they're also investing in new projects with their recent $500 million investment. And all this can drive even more cash flow and even more profit in the near future. And now let's sum all it up to our metrics. Their market cap is at $735 million. So the company is not huge. It's not even a billion unicorn company per se, but they're actually growing pretty good, and they can show they can sustain their performance over the years. Their current dividend yield is at 5.85%, which is pretty big. And looking at their 5-year average dividend yield is at 6.17%. So it ranges at the same territory right now because the company actually recovered from the lows of last year, and it's lined up to move forward with the same trajectory. You know, you cannot predict the market, but this is what I see and this is what I think is going to be happening. But what we care about here is that how they can sustain these dividends, right? as their payout ratio right now is at 87%, and their funds from operation, as I just said, also grew from $7.9 million to $19.5 million. So these two metrics are actually what can sustain our dividend payments. The good part about this company is that they pay dividends on a monthly basis. So every single month, you're going to be getting dividends if you invest into this company. Looking at the share price growth over the last 3 years for this company, it grew by 30%, which is pretty good, also considering what happened last year with the whole market situation. But can they do it going forward? I don't know, nobody knows, we will see. Their current drip amount is at 1800. So the drip is very easy, and what drip means is that whenever you invest in a company, you're getting paid dividends, right? And drip is Dividend Reinvestment Plan, which is basically an automatic way to reinvest dividends back to the stocks they're coming from, or ETFs. And with this company, you need to invest $1,800 into this company in order to get enough dividends back so you can reinvest and purchase a single share for this company, which is going to be even better for this company because they operate with dividends on a monthly basis. It means your drip is going to kick in every single month, and you're going to be reinvesting and getting a single share on a monthly basis, right? So it gives you 12 shares per month. This is the way the compounding works, and this is how you can automate your investments and your dividend reinvestments as well. And their share price is below $10. They're actually trading right now at $8.2, which is pretty good, and it's an easy investment opportunity for all the new investors or for those who actually think the companies like this can perform better going forward. So you can also accumulate more shares that will give you more returns. Their beta parameter is at 1.33, so the stock is not very volatile, but they might be on a short-term period. And in my opinion, Extendicare is one of those companies who can sustain and deliver these dividends no matter what. And they're also in healthcare. This sector is actually pretty underrepresented in Canada, and it's pretty hard to find pretty good companies there. And Extendicare actually stands out pretty nicely. So if you're looking for sustainable dividends, easy drips, and a low share price, check it out. And the next one is going to be Rogers Sugar. The ticker symbol is RSI.TO. I know sugar might be not the best for your health, but it's very tasty and it's actually a pretty good investment sometimes. This company has been established in 1888 and they actually became the largest sugar distribution in the country. And they also on the top list of maple syrup distribution as well. I want some pancakes. And why would you care about this maple syrup or sugar distributions, right? What actually important here is that they're actually showing their financials, how this is actually working and how they're getting back all this money that they can use to pay dividends and also invest into their business to grow it. In the first 6 months, their revenue and net earnings increased by 7.7%. So this is just since the beginning of the year. And they're also increased by 45% versus this same period in 2020. Their share price actually fluctuates a little bit from like $4 to $6, and it stays there, well, pretty much forever. So yeah, it's a pretty cheap stock to invest to. Their share price today is around $5.6, which is pretty good. They're also considered a very easy drip investment, and I'll talk about that in a bit. But what can support these dividends that are used for these drips is that their cash flow actually increased by 31% in the last 12 months, which is pretty good to see. It means that they can reinvest this into their business for sure, but they also can sustain their dividend payments with all this. And going into the second part of this year and also into the next year, they predict they're going to increase their sugar distribution and their maple syrup distribution by a lot, which means that the company is on the right track. They can be also growing as the business and as share price starting very, very soon. And they also can sustain the dividends they're paying. And that is what is important for dividend investors who are relying on these dividends and who are building their portfolio around the passive income they can generate or compound their dividend payments and reinvest them back into the stocks. These stocks or other stocks, that's your choice. And now let's bring all this together in our metrics. So their current market cap is around $600 million. Again, not the biggest company we've seen, but they're very sustainable and they prove they can pay their dividends no matter what. Their current dividend yield is at 6.13%, and their 5-year average dividend yield is actually at 6.39%. So they're hovering the same range. It doesn't mean the company is underperforming or is overpriced right now. They're actually in the same spot for a while now. Their current payout ratio is actually a little concerning, is the 112%. But apparently they start to improve it, and since the beginning of this year, they added a lot more into their operations, and we can see more in their next finance report. This company pays their dividends on a quarterly basis, so we're going to be getting our dividends back every single quarter. Looking at the last 6 years, their share price grew by 43%. So we can see this sustainable growth over the long-term period, but they've also been in the same range for a while now. So this company is definitely not a growth stock. Well, it might be one day, but not today. And so you need to consider that for sure. And now the fun part, their DRIP amount is actually at $500. So you can invest just $500 in this company and your DRIP is gonna kick in every single quarter. You're gonna be getting back around $6 in dividends every single quarter. This is not a lot, and you can invest $1,000 and get enough dividends back so you can purchase 2 shares of this company. Or you can invest $2,000 and get 4 shares of this company every single quarter. Or if you can go nuts, you can invest $10,000 and get 20 shares of this stock every single quarter. This is the way the automatic reinvestments are actually working, and this is how you compound your investments. This is how you can grow them over time. So this is a company where you can establish your DRIPs very easily, and with as little as $500 investments, you can already reinvest your dividends automatically back into this stock. Just to remind, not all the brokerages actually support DRIP. For example, Wealthsimple, and there is no DRIP there yet. I hope they're gonna add it soon. But Questrade actually has it. You can find the links below for these two and start your investment journey, start getting your dividends back, and start compounding your growth over time. Back to our stock, let's see other metrics for them. Their beta parameter is at 0.59, so it's a pretty volatile stock, I would say, on a short-term period. But again, as I said, their share price has actually been the same, around the same for a while now. So we're not expecting any huge drops without the same comebacks to the same price after a short-term period. Their current share price as of today is around $5.26, which is a very easy investment opportunity. You can start investing with as little as $5.26 and already own a single share of this company, which also pays dividends back. How cool is that? And then you can grow that over time. And it shows you here exactly that investing is not for only rich people or only who can invest thousands and millions of dollars. You can also start with as little as $6 in this case. And this is great. Let's get more people into investing, because this is one of the ways, one of the best ways how to grow your financial future and how to make your financial future independent. And my last comment for today is that TSX is actually lined up for an explosive 2021. They've been showing it in the first half, and now we're moving into the next half, where I hope they're gonna do the same or even better. And we'll see it together. Let's just keep investing. Let's start our investing if you haven't started, and we'll grow with the market. Thank you for watching. Don't forget to smash that like button, subscribe to my channel, hit the bell, and I'll see you around. All the best there. Cheers, bye.